Welcome to our video about taxation in Slovakia in the year 2025. If you press full screen, you can better read the information provided in this video. Remember, the taxation system of Slovakia can be used as an excellent complement to those of other countries. Zugimpex helps customers to combine the advantages of Switzerland, Slovakia, Malta, and other countries. We know which steps are necessary. With our local offices, we offer various services from one source.
Please tell us more about taxation and tax benefits in Slovakia.
There is a tax of 21% on corporate profits, and a reduced rate of 10% for businesses with revenues less than €100,000 in the tax period. Also, there is a small minimum tax that can be used in the following 3 fiscal years. Capital gains remain tax-free if certain conditions are met. Dividends are taxed with 7% if the shareholder is a physical person. In Slovakia, this is a final tax and not an advance payment. There is no dividend tax if the shareholder is a corporation. However, there is a 35% withholding tax if this corporation is in a country that is deemed to be a non-cooperative jurisdiction.
For individuals residing in Slovakia, there is a tax of 19% with a one-time progression to 25%.
When Slovakia residents receive dividends from abroad, they also pay 7% tax, and when they come from a company in a non-cooperative jurisdiction, the tax is 35%. Outgoing dividends usually are taxed in the country of residence, so a real change of residence may be considered, but also a partnership in a third country in the middle, of course with real activities.
Why? Do you recommend a partnership?
Because profits of a partnership qualify as business income according to most double tax treaties. According to Article 7, business income is taxed only in the country where it arises and not in the country of residence.
Slovakia has liberal business laws and competitive tax rates, especially for companies with external owners. You can benefit from it. Book your first free 20-minute consultation with a consultant at Zugimpex. Click on the link below. In Slovakia, however, the limited partnership has a special legal structure where the group of limited partners is seen like a corporation. Therefore, the limited partners are subject to the dividend tax, too. If a double tax treaty defines the exemption method in Article 23, there is usually a clause that states that other income of the owners will be taxed in the country of residence at a tax rate that is based on the total income. In some countries this is accepted in both directions, then losses of a partnership in Slovakia can be used to reduce the tax burden in the residence country.
Slovakia also offers interesting possibilities. For accounting policy, for example, depreciation rules or rules for the evaluation of inventory. This can be combined with group taxation in other countries, which may allow compensating losses in Slovakia with profits of associated corporations. Losses can be carried forward, but it is only allowed to offset 50% of annual profits with them each year.
What are the advantages of a KS with an S.R.O as a general partner?
The KS is a limited partnership. Limited partners are liable only to the extent of their registered share, but there is a requirement for at least one general partner who is fully liable. In Slovakia, it is possible that a limited liability company is registered as general partner. Then the liability is limited for the general partner, too.
The advantages of a KS with managing S.R.O as a general partner are: the partnership is subject to 21% corporate tax, and companies with up to €100,000 turnover pay just 10%.
In most countries, the profits of limited partners are not included in the assessment basis for Social Security contributions. If such a country is the applicable country of competence for Social Security, no social contributions must be paid. There is also no contribution if the partners have already reached the maximum level in their country of competence. Let us look at a comparison. In many other countries, total taxation of the owner of a corporation is often around 44%. First, the corporate income is taxed, and then there is a tax on the private level on dividends received. Often, there are in addition Social Security contributions. Slovak tax often remains in total at 26.5%, thus creates huge savings. and small companies pay only 16.3%. That means, a businessman in a country with 44.2% tax and around 26.5% social charges works from end of April only for the government. If the same businessman uses the benefits from the Slovak model with 16.3% tax, he can keep the profits of more than 10 months. Businesses that transfer activities to Slovakia also benefit there from lower wages and prices, but also from a liberal legal framework. However, also consider the tax progression in the country of residence, additional costs for restructuring and permanent structure costs to perform a real business and to avoid classification as misuse.
A KS should not have mainly passive income in order not to be qualified as a pure financial vehicle without business income.
In addition, it is recommended to consider how the country of competence for social charges can be defined and eventually transferred using the rules of the EU Directive 883 from 2004. Many businesses choose Slovakia for its advantages, but the real value only comes with the right setup. If you want to go deeper, check out our video on how to register a company in Slovakia quickly and properly, and how to avoid unnecessary costs. Let Zugimpex help you build a setup that works for you.
Is Slovakia a good place for establishing a holding?
Of course, because Slovakia allows receiving dividends tax-free and distributing them at a low rate to natural persons or tax-free to legal persons. First, the KS is mentioned in the Parent Subsidiary Directive of the EU and qualifies to receive dividends from many countries tax-free. Also, it is possible to use an S.R.O as intermediary holding with real substance. This company is subject to the Parent Subsidiary Directive of the EU, too. It can receive dividends from another EU country and forward it to an active partnership in Slovakia, all tax-free.
Third, capital gains from sale of subsidiaries remain tax-free, however the participation must be at least 10% and there is a holding period of at least 24 months. Fourth, as already mentioned, Slovakia charges 7% on dividend payments to individuals. If the owners have their residence in another country, they may receive the payments from the KS there without additional tax in most cases.
I heard that it is difficult to get a VAT number in Slovakia.
This is the case. VAT registration according to paragraph 4, that allows deducting input tax is handled restrictively by the tax office. At the application, the office requires an evidence that there are sustainable sales to regional companies of at least €50,000 per year. Registration according to paragraph 7 is easily possible. With this registration, the company can issue invoices abroad immediately, however the input tax is not deductible.
Tell me, what does this exactly mean?
This means, if a company purchases services from abroad, the tax liability for VAT is transferred to the recipient who has to pay the VAT. This is called the reverse charge system. But without paragraph 4 registration, the company is not allowed to deduct the same amount of input tax, so the result is a loss of 23% of the costs of the imported services. Also, the VAT of 23% for local purchases is lost.
What can be done to solve this problem? Well, there are always solutions, and it is our job to find and recommend them. You can buy a company with existing VAT registration according to paragraph 4, you can engage in local sales and apply for a VAT number despite the bureaucracy, or you can structure your business in a way that you receive goods and services in a branch abroad.
This way you can comfortably start your Slovak business and enjoy the benefits. Thank you for watching this video. If you found it helpful, give us a like and subscribe. If you have questions or want support, Zugimpex is here for you. Click on the link below and you receive a free first consultation.